And of course, the response that sometimes from LPs that are just unfortunately a little bit clueless is, well, that's okay. Like it's just going to accrue and I'll get paid later. And the problem is, like, you're right on the first part, it does accrue. On the second part, you might not get paid later.
Welcome to the TCO Method, the only show focused on helping you massively increase your net operating income. I am Andy McQuaid, and thank you so much for tuning in to this special interview episode with my guest, Aleksey Chernobelskiy. He has this insane background that I'm going to read off right now, and you guys are going to, your brains are going to melt. All right. So currently, Aleksey is taking time and advising LPs, limited partners, right? Investors, on existing and future investments, specifically, probably mostly syndications, but we'll get into that. He writes weekly on his Substack called lplessons.substack.com, write that down, to 1,500 investors so far. That list is constantly growing. And he helps explain how to do your research, to vet, and how you need to think about your LP investments in your portfolio. He helps GPs, general partners, on matters relating to LPs, like how to frame capital calls, and he provides feedback on their investment decks. Prior to doing all of this crazy advisory work, he ran Store Capital's $10 billion commercial real estate portfolio, oversaw the firm's underwriting team, and his educational background is nuts. He graduated from the University of Arizona with a quadruple major, which just makes my eyes bleed thinking about it because I'm that ADHD guy that just, no, that's not happening. Finance, mathematics, economics, and accounting. So born for Excel spreadsheets and numbers. No, I'm just kidding.
No,
Aleksey, thank you so much for joining me. I appreciate it. Your background is insane, and there's a saying in life that I adhere to is if you're the smartest person in a room, you need to find another room. I don't know that there's a room that exists where you wouldn't be the smartest guy in the room. So what do you do with that? Like, that's nuts.
I can tell you I've been in many, many rooms where I wasn't, by far. And those are the best rooms. I remember actually, when I got interviewed at Store, I met the founder, Chris Volk. And after about, a 5-minute interview, he said, I think you're going to be like one of the smartest people here. But before that, he went through like a bunch of examples on the business. And to be candid, like I understood probably 50% of it. So I came out of the interview and I just like told my wife, like I called my wife right away. I said, I'm not sure if I'm going to get that, but if I do, this is going to be amazing because I just love being around people that are much smarter than me.
So do I. So I feel that completely. Thank you so much for joining me again. And I guess the first question is, all this finance background, you could have done anything, gone anywhere in corporate America, and you chose real estate. How did that happen?
Yeah, I mean, so I actually started away from real estate. So I've more or less always been on the buy side. Really started with high frequency trading, if that means anything to you. So like algorithms. I did that in Israel. Then I did a little bit of distressed debt, a little bit of like private equity and venture capital work for a family office in New York, and then a little bit of consulting for the C-suite of Accenture. And then I got married, and that actually took me to Arizona. And so, although I've had quite a few experiences with real estate indirectly and sometimes directly, my first real estate touch was at Store Capital. That interview that I was thankful to get an offer for, and I did pretty well there. And ultimately, like you said, ended up running the portfolio that they had. I think by the time I left, close to 3,000 properties, maybe 2,900 or something like that, all across the U.S. And it was a 20-person team that essentially looked at managing that whole portfolio of real estate assets all across the US, but also underwrote new ones. So any new transaction that came through my team. And my goal in every single sense of the word, it was figure out whether the risk reward makes sense on a given transaction, right? Like hypothetically, we had endless money as a public company to buy anything we wanted. But of course, the risk reward balance is really important because you want to buy good things that are good for your shareholders and over a long period of time that ends up showing. So my team was tasked with putting together investment memos. I sat on an investment committee and you know restructured a bunch of deals. So yeah, it was like in a way, looking back, I mean, first of all, it was just like a phenomenal experience, and I learned a lot. But now that I'm in this new role, that the new venture that I founded, I'm realizing how helpful that experience was in framing a lot of things that I write about today.
Absolutely. I mean, your content is great. The Twitter and LinkedIn stuff that you put out is amazing, and your Substack has really taken off. How long ago did you launch that? And you're at 1,500 subs already?
3 months. I think now I'm at
That's insane. Congratulations.
1760 or something like that. 1770. I can't remember.
That is awesome.
Yeah, it's an interesting niche. I think there's a lot of limited partners out there that really want to learn more. And I feel like it's a very interesting balance of both being a very highly capitalized space. In other words, you have limited partners that have made tremendous amounts of money, typically in non-real estate pursuits, and yet they generally don't know what to look out for, right? So I'll have several calls a week that this is where like the entire genesis of the Substack on my blog was. I have calls with a bunch of people that either learn some hard earned lessons, right? Or they just call me about a new transaction and they're like, wow, like I had no idea what I was doing. I didn't know that this was a problem. I didn't know this was a problem. And whenever I hear comments like that, I just think, well, chances are like a lot of people don't know whether that's bad or good. So I just write about it, and so in a sense, a lot of my advisory work is obviously everything is anonymized, but it's all sort of content for me to speak about and help other people without mentioning the GP and without mentioning the LP, of course, or the deal even. But there's a lot to learn from.
Absolutely. I do the same thing. I'll tell stories on the show. They have no idea who that customer was or what the property was I was talking about. So I guess my next little block of topics that I'd like to cover are just very much related to everything you do. That's why you're on the show. And the audience is, we talked briefly about it, but the audience is largely made up of real estate investors. There's not a lot of people who are listening to the show for anything other than that. It is very much focused on helping people not light money on fire. This is a little bit of a sidetrack for me, because I don't directly deal with the financials as far as underwriting deals or anything like that, outside of the numbers have to work and they have to be realistic. Like projecting 5 to 8 to 15% rent increases year over year for the entire pro forma period is insanity, and it's not sustainable. And there's never been an economic cycle that has supported it for longer than a few years. Yes, you strike while the iron's hot, but you can't just have it ad infinitum and expect it to work out for you. Bad things will eventually happen, which is what we're seeing now. So the last couple of years with ZERP and all the other stuff, a decade of bad policy has created the ability, or did create the ability, for a lot of companies to develop bad business models and then stay afloat because capital was basically free. Now we're seeing that kind of abruptly and painfully come to an end for many, like WeWork, right? And, is it mismanagement? Is it fraud? Is it willful ignorance? I don't have those answers, but maybe you do. But the reality is that I am a firm believer that everybody has the right to be an entrepreneur and to go into business and to make money and to be successful. Just because you can doesn't necessarily mean you should.
Yeah.
So what we're seeing now is we're seeing people, LPs largely, who have been traditionally looked at as dumb money, right? Or stupid money, however you want to say it. I've seen it referenced that way multiple times. Not by you. You've been very polite about not framing people in a negative light for not understanding the investments they're making, which is a very careful, very rocky road. And I don't think I would do very well with that because I'm a little bit more blunt than that. But there's this feeling that LPs and silent partners are not always the most business savvy, and that can be true.
Mm-hmm.
So, I mean, what are the biggest mistakes that you've seen? And I know you've written some amazing articles and made them free for people to read, but where are the biggest mistakes that you've seen from 2019, 2020 till now that, they're coming knocking at the door saying, we don't want to take this property back, but we're going to take this property back? Like how is that going? Capital calls, pause distributions, cash in refis. What are we looking at as far as rescue capital and
so
mistake
I
side?
took a few notes. I'll try to address everything. Kind of like maybe we'll try to weave it together, and obviously you can stop me if you want to pause on something. So you started on rent increases, which I think is an interesting topic. The way that I always like to explain this to LPs is there's nothing, I genuinely believe this. There's nothing wrong with assuming constant 15% rent increases, as long as the LP realizes that that might not happen. Meaning, it could happen, and we've certainly seen it happen in some areas, and there's probably justification for it to happen in certain areas in the U.S. for the next few years. We just don't know that it'll happen yet. So I never take issue with really any assumptions, as long as the assumptions are sensitized, and as long as the LP goes into a transaction understanding what will happen if this doesn't work out. And the way that this kind of ties back into the biggest mistakes, probably one of them is not understanding downside catalysts. And I always tell people, if you don't have the time to do due diligence on a deal, you probably shouldn't be investing. In fact, not probably. I mean, I would say it's stronger. I think you shouldn't, unless, of course, you have like direct real estate or investing experience that's very deep. And secondly, you should really take time to understand what, let's say, three things can go wrong that will have the maximum impact on your returns. This is the universe I deal with, and every single person that I speak to are extremely bright. I mean, in some cases, I get calls, "Hey, I'm selling a business. I'm going to have $50 million liquid. Can you help me think through some stuff?" And it's like, wow, like meaning you're dealing with people that are extremely sophisticated. It's just that they didn't make their money through real estate, and what they don't realize is when they look at a deck, and the deck says, like, look, passive income, like you don't have to do anything. It might even say 8% pref, but they forget that the pref comes from the same LLC that operates the property, and the pref is only going to be paid if and when the cash is there, and sometimes the pref gets stopped. The pref still accrues, but I'm saying the cash disbursements can get stopped. And of course, the response that sometimes from LPs that are just, unfortunately, a little bit clueless is, well, that's okay. Like, it's just going to accrue and then I'll get paid later. And the problem is, like, you're right on the first part, it does accrue. On the second part, you might not get paid later. It just depends what's going to happen. And so that framework of what I like to call it is verify then trust, as opposed to trust then verify, is pretty it was missing. And I don't know how else to say it. I think people got excited, and to be frank, some people made a lot of money in syndications over the past few years, and and things got pretty exciting, so they just kept going. But you don't want to be there when the music stops.
I think that's what we're seeing right now is the music has definitely stopped. And now there's signs that it might be restarting, but we're not going to get ahead of ourselves just yet. So when they're looking at these deals and they're trying to decide yes or no, I love the fact that you said maybe if you don't understand it, you shouldn't be investing in it. That's kind of huge. And I think in all things, even real estate, people don't know what they don't know, right? Half of what I do is highlighting things that other companies have done that have worked. And, you see the light bulb go off and they're like, oh, yeah, I guess that does make sense, but I never thought about it that way. Like, it can be something stupid like changing batteries and smoke detectors. Well, how much does that cost you in labor every year? Oh, I didn't really think about that. Okay, well, it's costing you a lot of money every year. Maybe you should go to something that you don't have to change batteries in every year.
Yeah.
Pay a little more now, save over time. So when you're, I guess, advising people who are calling you and they're looking at a syndication or they're looking at an LP for a different business venture, outside of not understanding the numbers or not understanding that side of the business, where are you seeing like the biggest red flags? Like, this is missing. And, if this investor had known this ahead of time or not been sold the bill of goods, like I don't really want to talk about the fraud thing and the improper advertising and the SEC crap. Like that's still to be decided, and it's going to be a mess no matter what. Let
me touch on. Let's touch on fraud just for a second. I think it's important. I think cases of true fraud are pretty rare, and they're scary. But again, I think the chances of getting into a real fraud is pretty minimal. As long as you do what I would call like baseline due diligence. And I would even say, obviously, this isn't a promise, but to the extent that someone looks at I have an article called like Top 15 Syndication Mistakes. If someone looks at that article, they understand everything in there, which is written pretty simple English. If you don't understand anything that's in there, then I don't think you should be investing. Now, if you do, and you've sort of vetted all of those things, then I think the chances of a fraud are like very, very low. Anyone can do anything at some point, but getting through those 15 things and not finding something is like actually pretty impressive, I think. And most deals will at least have one or three things on there that are perhaps borderline. And the way that I phrased that article was it was with a lot of intent. Like I don't think those things, the 15 mistakes, so to speak, are not red flags, because every single investment at the end of the day needs to be compared to other investments, whether it be real estate or something else. And what I called it is sort of 15 reasons to pause and think. In other words, if someone doesn't have a track record, that's okay. You should just know that they don't, and something else, so to speak, all else equal, has to compensate and make you comfortable, right? So I mean that's a little bit on fraud. I think the reality is, and I'll go into the second topic that you mentioned in a second, but where things get pretty difficult is what I would call a poor alignment of interest mixed with ignorance. Like those two things can become pretty dangerous. In other words, we're not talking about cases of people misappropriating funds. We're just talking about people that are either ignorant or overly optimistic or inexperienced. Sometimes a combination of all the three.
Too dumb to get out of their own way is how I like to say that.
But in a sense, like I have a lot of respect for people that try things, especially now that I'm starting a business. It's hard,
right?
And I have a lot of respect for people who try things, but I think there's a big difference between trying something and being transparent about the fact that you're trying something, and trying something and sort of like pushing out a totally different image for marketing purposes, right?
There's a lot of that, yes.
Yeah, and I think the best way I think I can answer your biggest mistakes question, just as a function of what's happening today, what's the common thread across people that I'm advising that you have either lost all of their investment or some of it or are getting capital calls? I think probably 75% of it has to do with alignment of interests, and 25% of it has to do with just vetting the sponsor. So, and I wrote pretty lengthy three pieces of the the path that I suggest for folks to follow. It might surprise some people that the last one, the number 3 of 3, and it's in order, is the property. In other words, when you're investing in a syndication, in my opinion, the last thing you should look at is the property you're investing in, which might sound like insane to some people, but I think in many situations you'll get through 1 and 2 and actually not even get to the property because there's so many things that you have questions on or uncomfortable with. Now, number 1 is execution, which, many topics to discuss there, but more or less that's a pillar that revolves around, can they actually execute, right? Which is partially track record, partially trust, a few other things that I mentioned, right? So there was definitely a lot of that missing. Like people just said, yeah, look, well, this guy seems like a nice guy and or a gal, and look at them, like they're trying to help the housing problem. Like why shouldn't I trust them? And I think my argument could be the exact opposite. Like, why should you trust them? And until someone has performed, there's no reason why you should trust them. And I think that's normal. They might be nice and they might have a nice smile and whatever and talk nicely and dress nicely. By the way, like while we're on this topic, they might also have lots of followers. They might also like be very famous. They might be a family member of yours. But all of those reasons are not reason to invest or trust someone. They're just what I would call a reason to look into the transaction, right? And those things should not bias you to invest. Now, the second pillar is what I would call alignment of interest. And that touches on a lot of different topics, but broadly speaking, it's co-invest, i.e., how much is the GP investing alongside the LP? And then the other thing is the waterfall. In other words, what happens if things go south? So the first thing is the co-invest. In other words, like how much money do they have at stake? How does that relate to their sort of net worth as a person? And is it a meaningful amount? And then second is, okay, so now that I know that they're invested, what practically happens to the economics if things go south? In other words, who gets paid first? What happens? Is there a return of capital clause, which is like a whole topic I can spend a lot of time on, because I was shocked to see that some agreements don't have it in there. But I think that is a big theme, Andy, is people forget that this is a transaction, and but in an investments are risky. Sometimes things don't work out, and the best thing you can do for yourself is to know that if things don't work out, you're being taken care of by someone who's incentivized to do something about it, right? And those incentives and those conversations have to happen day zero, because as soon as day one begins, it's already too late, and like they can just stop answering your emails.
Yeah, the ink is dry at that point. They have your money. You're just going to deal with what you get.
Yeah.
And there's always the horror stories, right? To every story has two sides, and there's the doom and gloomers, catastrophists, and the everything's fine, rainbows and sunshine and butterflies and rose-colored glasses, whatever. The concern that I have is seeing people getting into these syndications and being like, oh, it's real estate, it's a safe investment because there's an asset. Well, you're an LP. Is there an asset? Really? For you? Maybe, but maybe not. Maybe it's just evaporates, right? Maybe there's nothing for you. Oh, well, I can claim depreciation on my taxes. Do you have reps? Are you a full-time real estate professional doing more than 750 hours a year, doing more than 51% at that property? Can you claim depreciation? No. But you think you can because you listen to 15-second snippets on LinkedIn or on Instagram where they say, hey, join my thing, and this is what you can take advantage of in very specific circumstances. Maybe if you're lucky, you can make all that stuff work out as an LP. However, not understanding the deal is the crux of a lot of these issues, I think.
Yeah, so I think two comments there. I think you subtly mentioned courses. Join my thing. It might be courses, might be newsletters. I always try to remind people that all of those things are great. I have no problem with them. I think with anything though, an investor needs to be mindful of conflict of interest. In other words, if an industrial GP is telling you that multifamily sucks, that might be true, or they might just be sort of like diverting your capital to an asset class that they happen to be a GP in. Wink, wink, right?
Mm-hmm.
If a multifamily owner tells you like, "Oh my gosh, there's such a housing crisis, we're going to help solve it." I mean, I have general thoughts about that as a comment, but putting that aside, that also is like that's sort of like an appeal to emotion, and it happens to be that the person that's telling you that is also like a multifamily syndicator. Now again,
Mm-hmm.
I have no issues with that, and some of those comments and hypotheses that are being made are true and they're well thought out. But as an investor, you just have to, again, like I like to say, pause and think and be like, what am I being told, and what is the bias of the person in front of me? So I just think it's important to think about those things. And as far as taxes, I mean, I see some decks, and I'm in the middle of writing an entire article on the hidden, what is it called, hidden risks of property benefits, I think is the name.
It's a good name.
Property tax
If
benefits,
you
yeah.
know anything about it, it's a really good name.
Yeah, and so I think to your point, oh, I see a lot of people get into things. Oh, like I'm gonna have a crazy W-2 year. I'm gonna offset my income, and so many things happen. Like a GP forgets to do the cost seg, or doesn't do it on time, or perhaps to your point, like they don't have any passive income, which is different than your W-2 income. I can go on and on. I mean, I have like a whole article on this, and I think people just forget that, tax benefits, they're great, but they're not always free, right? And I think it's important to go into a transaction with a solid perspective of what could happen.
I agree, and I think that's hugely valuable. What you're bringing to everybody is it's giving them information that
Yeah.
maybe they don't have a source for because they don't have a lot of real estate contacts, right? We see you browse LinkedIn for 5 minutes and scroll your feed. If you're connected to real estate people, you're going to see airline pilot that's helping people invest in real estate as a syndicator. You're going to see doctors, you're going to see dentists, you're going to see lawyers, you're going to see all these different people working W-2s, having great careers, focusing on helping those other people come into the fold so they can make some money while still working their W-2, draw a check, be an LP, do all this other stuff. It's great. Except for these are not people who are real estate natives either. So you have to trust the source. And how do you do that when they don't have a vetted background, right? So for me, it's a red flag when I hear people, on Instagram or whatever being like, oh, tax benefits, own real estate. Oh, well, even if everything falls apart and the investment fails, you still have an asset. You might not, actually. And you need to follow the money. That's what I tell people all the time is when you're listening to somebody who's trying to sell you something, when you're listening to somebody who's doing a podcast or doing a whatever, what's their goal? Why are they doing it? Where's the money going? And why do they want you to be involved, or why are they pitching this to you? It always comes down to where's the capital? Where is that money gonna be? And how does it influence them? So when we hear these nightmare stories of the people who are getting into these syndications and getting into these investments, and now there's capital calls, and the capital call is, I think it might have been one of your examples where the capital call is, we need you to give us another X number of tens of thousands of dollars, so you might get 40% of your original investment back, or you get 100% of nothing.
Yeah.
Those are the situations that now people are going, oh my God, I had no idea. I need somebody to scapegoat and blame. So I want to do this SEC lawsuit, or I want to do this lawsuit, or Grant Cardone is great big asshole, whatever it might be. How do people, like, if they're not involved in real estate and they're bad at Google, right? Because obviously a lot of people had to have been bad at Google because this is not something that's new. The snowball started 12 months ago in some cases. Where should people be looking other than lplessons.substack.com?
Thanks. Okay, so let me touch on a few things here. So, I think you mentioned twice now, like the idea of real estate being a safe asset class. I probably hear this at least once a week from people that are way wealthier than I am. And on the one hand, that blows my mind. On the other hand, I have like a real dialogue with them. Like they'll tell me, hey, I feel like this is a really safe investment and a pretty solid way for me to make 15%. So what I tell them is, can you see a path where it won't be safe? And most times, Andy, the answer is not really. Like, I don't think I can lose money because it's an asset, and if something goes wrong, I can sell it. To which, of course, I just continue the dialogue, and I'm like, okay, but like, what if they sell and it happens to sell for less than you bought it for, and maybe it's gets sold for around, your debt basis, and then they start thinking, and they're like, oh, so you mean to say like asset prices don't always go up? It's like, well, yes, partially it depends on cap rates, partially it depends on NOI. Both things could change and impact you negatively, right? So, but the reason why I'm telling you this is like this is a very common. I mean, sometimes you'll hear like, well, everyone needs a place to live, so therefore it's safe, right? And as a comment that isn't entirely false, like meaning there's demand and but of course, you and I know that like there's a lot of things that can go wrong. One of which, as we learned, obviously, is just high leverage and floating rates, but there's a bunch of other things. A quick comment on Google, since you mentioned it. I always recommend people to Google the GPs that are involved and understand whether they've been involved in anything that they should know about. And honestly, I always say like 50% of the time, there's nothing wrong with lawsuits, by the way, like they're part of business. But sometimes you'll see lawsuits like right there on Google, like second result, that are pretty big and potentially questioning, the ethical nature of the GP. At which point, again, I think of this as investments, right? Risk reward. So like your risk just went up because of the execution variable. Does something else compensate for it? Are you willing to take on that additional risk of this article or lawsuit being true? Maybe it's false, but you should at least know that it's a thing. Another thing you mentioned is, just this pretty prolific, to be honest, idea that like a W-2 worker will get, their other doctor friends, dentist friends, attorney friends, sales friends. I don't know, like, you know what I mean. I think there's probably one of these for every field. In principle, I have zero problems with that. I think it's great because it like exposes more people to the idea of real estate investing and those benefits. Where I start to have a problem is when incentives are misaligned. So the question is always, what is that person doing? Many times they're not actually buying the property themselves. They are like putting together a fund that essentially becomes like a fund of funds that goes, or a special, SPV that goes into the ultimate GP's equity position, right? Either on the GP side as a co-invest on the GP, or more often as LP capital. Where I think this goes a little bit haywire is like you always, as the ultimate LP, right? In other words, there's the GP, and then in between us is like the person that you're speaking to, and then you're like over here, and the question is like, what value is this middle person bringing to me? If you feel like the value is really there, then fine. Like that if you feel like they've properly vetted the deal and then they have the experience to do so, and the compensation that they're receiving for your capital, which they often do, and many times it's not disclosed, then fine, no problem. But where things go wrong, and I've actually advised on a few cases like this recently, where someone invested through a fund of funds, and now like the GP is in distress, the ultimate GP, and the fund of funds is essentially just pointing fingers. Like we don't know what to do. Like we're not in control. But we're not in control. But we still need you to fund the capital call, and it's due on Friday. But we haven't really talked to the GP, and we don't know what the plan is, right? So that's a pretty real additional risk layer because you're one additional step removed from the GP. If you feel like you're getting the benefit of whatever fees and potentially double promote and et cetera, that you're paying, then great. But also don't be clueless and assume that like people are just doing this for free. That happens a lot.
Absolutely. I have seen it personally. So yeah, there's some interesting ones that I've had a back seat to watch sort of disintegrate. Not as an investor, thank God, but just through the being surrounded by real estate people 24/7. It's a mess, and it's amazing to me how many people will invest with someone who has zero ownership stake in the success of the property or of the syndication. Like, yeah. You're giving these people tens and hundreds of thousands of dollars in some case, and the guy you're trusting to make this go has zero incentive after acquisition to make it work. Right. Why are you giving them money?
And I would just add one more thing. Not just incentive, but control. Like those two are different things. Right. In other words,
truth.
Someone might have an incentive through like a piece of the promote of the GP or something, or maybe perhaps they take some of your proceeds as an LP. But incentives don't really matter in downside scenarios. What really matters is like, can you actually do anything? And in 99% of cases, fund of funds are completely helpless. This is like getting technical, but like, there's like manager removal clauses and like, what do you do? And by the time you can do anything, it's usually too late. Which actually, another thing I wanted to just comment on is lawsuits. When things do disintegrate, I think people have this idea that, look, if something goes really haywire, I'm just going to sue the hell out of these people. Not legal advice, and I'm not an attorney, but just from what I've seen, this is much harder than people think it is. I think there's certainly, if someone wants to sue just to sue, no problem, right? But you have to keep in mind that generally speaking, the probability of monetary benefits out of a lawsuit are pretty small when you consider the fact that like by the time that your property is doing not well, there's also a chance that the GP is not doing well. And if the GP is not doing well, like there's not much money to pay you. They can just file bankruptcy. Like there's so many different things. And obviously like anyone can sue, but really what matters is like what is the probability of you winning actual dollar amounts. And unfortunately, in many cases, when things go south, like the answer to that is zero.
Yeah, blood from a stone. That's
more or less, yeah,
a very real result in a lot of this. And if you're only in for 50, 80, 100,000, what are you going to spend on legal fees unless you can somehow figure out how to class action it or something and split costs between multiple claimants? Like where is the capital to support that going to come from? Because it's probably not going to come from the sale of the building, right, or of the property. Yeah, I mean, it's a mess, and it sucks because people are being, in some cases taken advantage of. In some cases, it's just getting in trouble for being dumb money. Like you just don't understand the nature of the beast that you got yourself into.
Yeah, and this is it's probably a whole topic, but just quickly, I think there's obviously a delicate balance between like what a GP has to disclose and how much they need to, the responsibility, right? What are the responsibilities of a GP and the responsibilities of an LP? Like this is a very interesting, in my opinion, ethical discussion.
Yeah.
And I'll just give you one example. Like recently, I spoke to someone who invested in a ground-up development, and the deck said that there's an 8% pref, and the guy just assumed it's current. So like a quarter in, he's like, hey, like, where's my first dividend? I was expecting it to like pay something. Like he like meaning he was going to take that money and use it for personal needs. And the GP just kind of looked at him and was like, "Are you like crazy?" In a nice way, obviously, but he was like, "This is a development. Like this money is accruing, and we'll pay it to you eventually, or current when we can. But like you're looking at a piece of land. There's no cash, right?" So in circumstances like that, it's interesting because it's like, well, I think that's like an LP's responsibility at that point, like. But you could also say maybe the GP's deck could have been a little bit more clear, right? So
Yeah.
it's like it's a very
For real
interesting
estate
discussion.
guys, yeah, just in that case, as a real estate guy, I look at that and I go, of course, it's a piece of land. It's not going to cash flow, right? Because I've been around construction my entire life. I know how construction loans work. I know how they structure those. I know how the inspection cycle goes. You're not getting paid because there ain't no draws. Like there's nothing happening right now. There's no cash flow of any kind.
Yeah, yeah, but I think the question of responsibility is interesting. Yeah, because to an extent you can say, well, the LP should have known. What were you thinking? Right? Is one approach.
Right.
And another approach is like, well, the deck wasn't entirely clear. It could have said like, yeah, it's 8% pref, but here's what we're planning to pay in terms of cash flows. So it's a balance. And look, I ran a 20-person team that made, I mean, we probably looked at, I don't even know, 30, 40 deals a week. And like many of those ended up being investment memos. And I can tell you, like every single deck had some sort of mistake. Just like little things, formatting things or whatever. Like it's difficult to produce a lot of stuff, and many times you're in a rush, and there's nothing wrong with that. Like you just you answer sort of like you come to investment committee and you discuss, and it might be 90% done, and that's better than waiting a few more days but having it 100% done. Right. And that's okay.
Yep.
That's okay. But then it sort of falls on in back in my day, it was like the investment committee, including myself, to like question some of the things inside. And now in our case, what we're discussing, it would be the LPs. Like you need to ask, like, hey, is this 8% starting immediately?
Yeah, there's a lot of assumptions and gray areas, I think, because when you're in it and you're working it all the time, it's just second nature that, oh yeah, well, I'm not going to see a penny of that until there's actually, somebody occupying the property, right?
Yeah,
it just
exactly
goes without saying for us, but for a doctor or a dentist or an airline pilot, they have no idea. Like, hopefully they read the fine print in the 144-page contract that they signed. Maybe not. Most of them probably didn't, unfortunately. And if they did read it, they're not lawyers, so they probably couldn't translate most of it into English anyway, right?
And I'll tell you one more thing is, to your point, many of them don't read it. I think it's a really good idea to read it, just at least for an educational perspective, other than just you're signing up for a contract.
Right.
But what's a little bit more scary to me is sometimes they've actually used attorneys, and the attorneys, I mean, they probably read it, but they didn't catch like the completely off market terms in some certain circumstances. And that makes you wonder, like, if the LP can't catch something, and I'm not talking about like, the acquisition fee is 3% instead of 2%. I'm talking about like 6%, or in some cases higher, I've seen. And again, nothing wrong with that. But at least going into it, you should know, like, hey, I'm kind of paying a high acquisition fee, but I'm okay with that because X, Y, and Z, no problem. But the reality is, many LPs got into stuff not understanding that, and the attorneys who I think should be seeing a lot of these things and presumably know what market is, also don't know. So the way that I like to describe it is, a typical LP, a client of mine, is like a dentist sitting in his like lunch break room, looking at a deck, calling me like, "Hey, is this market? Is this market?" And without me, like perhaps there's a few other doctors sitting around the room, and they're discussing it amongst themselves, but their purview, so to speak, is very limited to other things that they've seen, and that's interesting, because when you don't see a lot of different deals, you're not really sure what's market. So it's like, well, who cares about the 6%? Like, I don't even know if that's market or not. Let's move on. It's a good
Right.
deal, you know? So,
Yeah. But they don't, the guy saying that also doesn't know how to run the numbers and how to look at a pro forma or how to look at how
right.
a trailing 12 could possibly, if it's already existing, how a trailing 12 is going to maybe not be completely honest right off the get-go, right? Because there's no you don't get to see the extended due diligence that the GP is going to do on acquisition. You're not going to see, whatever third-party property manager that comes in that's going to just, use bubble gum and paint to hide all sins and try and get this thing occupied for as cheap as possible while they're pocketing the extra fees. Like, I've seen all sorts of nightmares involving people coming in and saying, oh, well, it's a 2% acquisition fee. Well, the fine print actually says it's 2% of the total acquisition cost, including the bank funds, but not the 2% of the money coming from the LPs.
Definitely.
They're actually taking like 10 or 12% of the LPs' money because they're not taking any of the bank money. They're taking all of that capital out of the LPs. I've heard that horror story. Are you kidding me? How do they get away with that stuff?
So acquisition fees generally are a percentage of acquisition price, like the purchase price, which to your point would include the debt. But that was a topic of one of my earlier posts because I think people don't understand. Like to your point, many of them think that the percent is part of equity, and they just don't. I mean, they just can't. They don't learn that it's not ever. And another part is they just don't understand like the impact of paying, let's say, a 6% acquisition fee on 80% loan to value deal is insane because like that 6% isn't really across your 20% of equity. It's
Right.
across the entire stack. So you're actually like day one, you're in the red by a lot. In some cases like 20%, 30%. And of course, again, no problem with that as long as you're aware and you know that like you're in the red, but I'm going to make up for it by X, Y, and Z, and that's why I believe
Right.
in the deal. I'm okay with that. But many people, just from my experience, just don't realize that.
No, I think that it's a lot of, oh, well, real estate's awesome. It's stable. There's an asset. I can do this. I can do that. And they don't know the rest of it because everybody's, oh, buy a house. It's stable. It'll help you build wealth for your family and generational wealth and all this other stuff. But if your name's not on the title or on the lien, you really don't have an asset until you do. And some people don't know how long it takes to actually get there. Right.
Yeah. Look, at the end of the day, it's a big investment spectrum, which is another thing that I try to remind people of. For whatever reason, sometimes people think like if I don't invest in this, like the GP is not going to contact me again. I'm too afraid to ask questions, and it's like, look, the worst thing is, so to speak, put your money into treasuries at 5%, and wait until you get the next deal or meet some other folks. Like, it's okay if you miss it. Nothing will happen. And the cost of making uninformed decisions is so much more painful than missing, a 20% IRR deal and instead putting your money into a 15% IRR deal, which was, another topic of mine that I wrote about. Like, if just to give you an example, like if you lose 50% of your capital and then you take that capital that you got back. In other words, you invested 500K, you got 250 back after they, made some mistakes, and then you go invest it at 8%, which is, risky capital, right? Because it's more than what you can get risk free. In other words, it's not so simple to just get 8% without any risk over a long period of time. But let's say you can. So that needs to compound for 9 years for you to just get back to your 500K. And I think people just don't think about that sometimes. It's like, well, it's not going to be me. It's not going to be me. But sometimes it is you. And
sometimes
when it is you, it's like really painful. What I think people do have very right about real estate being a safe asset is that it actually should be pretty safe in a sense. In other words, if you invest correctly, the downside should be very limited because your upside it's not limited, but like no one is going into real estate to 10x. or 100x. Like
Right.
that's a venture capital type, very speculative investment. Real estate is not meant to be that way. So if you know that your upside is capped at, let's say, it's not capped officially, but like what's on average over 5 years, you're 2x your money,
Realistic.
like that's really good, right?
Hmm.
So if the best you can do is 2x, so to speak, then you should be pretty sure that like the probability of you losing your money or losing a substantial amount of your money is pretty low.
Yeah, absolutely. Well, I think, again, the last 10 years have, maybe 15, depending on who you talk to, but ZERP really crushed the ability for, I guess you'd call it natural selection, to do its work. People with bad business models, without controls, I've talked to operators who haven't run a CapEx reserve in 6 years because they didn't need to, because they could just get a note for 3% and finance it for nothing. Well, those days are over. So,
Yeah.
like, the business models that worked maybe aren't going to keep working. And I guess this is probably a good transition point, because we're getting up on time, is the Fed announcing potentially 3 rate cuts. I personally think it's politically motivated to some extent. I don't like either party. I say that on my show all the time. One side likes to stick the knife in your chest a full 12 inches. The other party likes to stick it in your back 6 inches. They're both assholes. So don't trust anything, because it's all about getting reelected, and they don't give a crap about what really happens in the real world. So let's get that out of the way. If they do 3 rate cuts next year, great. People are literally like popping champagne who are specifically in real estate, specifically GPs and syndicators. And I'm going, have you guys learned nothing from the last 15 years? Like, we're paying the piper now. There's so much that could possibly go wrong. And read a news report from December of 2007. This is very, very familiar to me. Coming, like, I had just exited doing stuff for a lumberyard, working with single family home builders, to go to a place that was focused on DIY and single family renovations, and eventually turned into multifamily for me at the Home Depot. In 2007, I left in September and took that job, specifically seeing the writing on the wall. So, like, I am scared right now that this irrational exuberance is going to spiral, because 2 things can happen. Everything can work out, soft landing, great, no recession, everything picks up. And then the other thing is, what happens if we get hyperinflation? What happens if we see inflation start to heat up again? What happens if all of this craziness that is now costing people money, pause distributions, capital calls, all this other stuff, business plans built on a lack of understanding of fundamentals, right? And then investors investing in those deals based off of this irrational exuberance. Like, people were about to pay the piper and have a come to Jesus meeting, and now they're throwing parties and drinking, and it's like, dude, it's been 3.5 hours and you're already celebrating, right? We're recording this on December 13th, and I can't believe the amount of insanity I'm seeing. It's like they forgot the last 12 to 18 months of pain that they've been through. And at the end of the day, if it's 3 cuts, it's going to be a 0.25 point to 1 point all in.
Yeah.
Maybe there's some opportunity there to restructure and make things less painful.
Yeah.
I don't know that there's a way for these people who are celebrating to unbury themselves. Like, 1%. It's a lot of money when you're talking about tens of millions of dollars.
Yeah.
But it's 1%. I don't think it's going to move the needle. I don't think we're going to see 3.9% anytime in the next 18 months. But I don't want to prognosticate either. I just think that it's insanity based on just the last 12 months of crying and survive till 25. And now it's a party.
Right. Yeah, look, I'll just make 2 comments. So one, I think in terms of the good news, right? I think there's really 2 things going on. One is obviously the rate cuts, if they do happen, I think will have a somewhat direct impact on what the banks borrow at, and therefore it should, all else equal, trickle down to borrowing costs to real estate operators who are, presumably planning to refi or need to refi or whatever. That, to me, to your point, is actually it's a subtle point. I don't see that as being very good in the grand scheme of things. I don't like it. It's certainly positive. Rates going down is helpful. I think what's potentially a bigger theme at play is just people getting more comfortable with the risk. So what has happened, especially in the lending world over the past year and a half, is lenders are just so uncertain about the future that the spreads got to a point where like you effectively just couldn't get a loan to make anything make sense.
Mm-hmm.
Now, I think what will happen on top of lowering rates is the fact that at some point you'll see a tightening of that spread, and therefore things will become even more affordable, right? And that I think combined with the lower rates actually could have a pretty deep effect in terms of the securitization markets, CMBS markets. Like
Mm-hmm.
people will sort of, lack of a better word, is like come back to play. Where everyone else until now has been, on vacation, more or less, pretend
Well,
lending,
yeah.
if you will. Um,
Mm-hmm.
so those two are the kind of the good news. The bad news is like, as I always like to say, I think any GP or LP for that matter, unless perhaps you're, an economist yourself or something, like I just don't think the real estate game is a game of predicting rates. Certainly, it impacts the business. Certainly, you should sensitize to understand how things could impact your investment, both for the good and the bad. But if you're getting into a rate sensitive bet, at some point, I mean, this sounds brutal, but it's like at some point you might as well just go trade rates. Like, why play
Right.
rates through real estate? Go trade rates. Like if you are so convinced that something is going to happen, so take that bet and make more money with it.
It would make a
Seriously,
lot of
like
people a lot happier compared to some of the insanity that I've seen for the last couple of years, and now all of a sudden it's like they're drinking champagne. I'm like, are you guys out of your minds?
yeah,
They've
yeah.
learned
And look, I
nothing.
mean,
They've
I
learned
think
nothing.
part of it is they just had like a rough 18 months. So,
Yeah. Yeah.
but
Fair
to your
enough.
point, I think there's like probably a balance. To not over celebrate and not
Yeah, I'm
expect.
I'm a big believer in the conservative underwriting and the numbers having to work. And
Yeah,
if the only way a deal works is if everything goes right, the deal's never going to work. Like
yeah,
that's how I look at everything. Like when I do any type of money lending on storage or whatever, I want to see the business plan. Like the asset's great, but I have the asset, right? I want to see the
mhm,
business plan to make it worth more, so I make sure I'm not going backwards. And if
yeah,
the numbers make sense and you pay me on time, I'm happy. Like
yeah.
it's not rocket science. I guess we've covered a ton of stuff, and thank you so much because this is huge and I have learned more. Like my brain actually hurts now. My question, I guess there's two of them. The first one is, what haven't we touched on that you would like to touch on? I want, first of all, like in a minute, we'll get to how people can find you,
Mhm.
email you. We'll talk about the Substack again, but GPs, where should they be? Because I know you've done a bunch of, specifically very recently, advisory for GPs, putting together decks, putting together capital calls, doing all of this stuff. What should they be trying to do other than don't be shady, don't be a scammer, don't promise things you can't deliver? Like, what should they be doing right now?
I think the best answer to that is just be transparent. The worst thing that can happen to a GP, in my opinion, is figuring out the status of your investment through someone else. I think that just sort of discredits the GP. And I think if you're transparent and you communicate well, like I can't tell you how many capital calls I've seen that essentially say, I even tweeted about this, and some people thought it was a joke, but it's not. Like capital call templates nowadays are essentially like, hey, everything is going great, happy holidays. And then the second sentence is, we need some more money for this project. The third sentence is, we're putting together a plan of how we're going to use this money, and we'll send it to you over the next month. And then the last sentence is, here are the wiring instructions. You have until Friday, or you'll be diluted. Goodbye. And it's like, Wow, like seriously? Like how did you even come up with that? And now, partially I think like a lot of this is sort of like last minute decision making. People are freaking out. Perhaps they don't have enough information. In the case of like fund of funds and stuff, like there's a lot of things that could happen. But at the end of the day, communicating well and communicating early, I think will go a long way, especially during challenging times.
I don't disagree. A big red flag for me too is when they point the finger immediately to,
Yeah.
A property manager. Oh, the property manager screwed me, or the property manager is mismanaging. We're going to fire them and we're going to replace them. Okay, well, cool, but who's in charge of making sure that they're doing their job? And how do you know the next guy's not going to do the same thing? Like, I'm not a big fan of the finger pointing and the blame, like the buck stops here kind of thing. Like, you need to own it. So I've seen a lot of people not owning anything, and it's scary because I think those are the people who are going to end up in the lawsuits.
Yep, absolutely.
All right. And I guess the next and final thing, Aleksey, thank you so much for the time you've taken. Where can people find you? And what is your overarching message for the audience, for anybody looking to invest in a syndication or do any type of business deals in this environment right now when we're seeing kind of the worst of the worst float to the surface? Because it's always the worst stories that make the news, right? It's never that the happy stuff or the stuff that worked out. Maybe this isn't going great, but it could, it should be okay. That won't make the news. It's the nightmare scenario where everything is on fire and people are just losing their butts and getting zero back.
So I mean, I'll say broad statement is if you don't know how to do diligence properly or don't have time for it, I don't think you should be investing. And I mean, I'll stand behind that all day. In terms of the point that I'm trying to make, you always have to take a step back. There's two ways to view everything. In other words, on the one hand, there's like blood on the streets, so to speak, right now. On the other hand, there are truly some great opportunities that I'm seeing once in a while. And for those opportunities, like you have to have capital available, you have to be active, you have to know some GPs if you want to invest as an LP. And that's pretty important, to get yourself out there and just not feel like you have to invest in the first deal that you see. Like nothing will happen if you say no politely. And also, like, just one last thing is you mentioned that only some things come on the news, right? And I actually have a pretty interesting opinion on this. I think what you see on the news is GP X, Y, and Z gave back their properties to the bank. Okay. What you don't see, what I see, is the LP who calls me and says, "Hey, I invested $1 million into this. I don't really understand what this notice is about some capital call. Like, what does that mean?" And I have to explain to them what a capital call means, which isn't, my favorite thing to do. But B, once I like look into the information, I also have to explain to them that the existing position is worthless. And of course, going back to our conversation earlier, it's like, well, what do you mean worthless? Like, it's an asset. Can't you just sell it? Like, and you're forced to have this conversation. So the reality, I think the reason I'm telling you this is like the reality is both ways. Like you don't see a lot of like great publication about, hey, like I invested as an LP, let's say I invested in 10% of the deals that I see. I'm very selective, and here's my returns over a long period of time. Here are GPs that are good. There's nothing out there. It's like an extremely opaque space in terms of like the good news and the bad news, right? So that's sort of like the world, at least that I'm trying to address, is like to make the space a little bit more transparent. In terms of where to find me, I have a pretty unique name. I don't think it's that difficult. I mean, I write probably most consistently on Twitter and Substack. Twitter is like more short form. Substack is more long form. I would recommend people check out like the top 15 syndication mistakes article as a first start. And if anyone wants to email me, it's just my first name @hey.com, Aleksey @hey.com. And just educate yourself, please. Like, like it doesn't have to be through me. It can be through books, something. Just don't, make investment mistakes after spending so much effort in saving money.
Yeah, you've earned the money. Make the money work for you.
Yeah, actually,
so with that,
just really quickly, you just made me remember something. Like, I think accredited investor status is something that I have like a strong opinion on. I think it sometimes gives people this false illusion of being an investor. And it's not that they're not, like they do have this status, but they might not know anything about investing.
Right.
And what I found, at least through my work, is generally speaking, the same traits that make someone really wealthy can actually translate to like pretty bad behavior on the investing side, because you take risks. But notice that when you're taking risks in an operating business, it's risks that you control, and B, you sort of like at least somewhat understand, right? Because you're in this business. And then they sort of take that similar risk taking behavior to like LP investments, and they start like YOLOing across a bunch of deals.
Yeah.
And sometimes it doesn't end well. So in some sense this is kind of strange, but I have this theory that like almost the same character traits that make you really wealthy can actually like make you lose a lot of your money.
I don't disagree with that. Aleksey Chernobelskiy, thank you so much for coming on the TCO Method. I do appreciate your time. I want to do this again at some point. It's anything we can do to get the word out about your Substack, about what you're doing for LPs and GPs. It's hugely important, hugely valuable. Nobody else is out there doing it and beating the drum like you are. It is absolutely needed. I know that there's some people out there who are very cranky that you're doing it. I am not one of those people, because I think that there has to be objectivity in business and the numbers have to work. And if you can't make the numbers work, there's no reason to do the deal. Thank you very much. Until next time. Thank you
so much for having me on.
Everybody out in Radioland or on YouTube, please hit that subscribe button. Leave us a comment if you're on Apple, Spotify, iHeartRadio, anywhere else you get your podcasts. Please make sure you subscribe. Leave us a comment. Leave us a review. 5 stars is great. If you're going to leave me 1 star, at least send me an email and tell me why somebody on Apple left me a 1-star review and didn't leave any comments. And that just makes me sad. Anyway, thank you everybody for tuning in. Until next time,